This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Please don't go. Investors will be sorry to see 2017 end as stocks post their best gains since 2013. Portfolio Picks, our market monitor, has 3 stocks for the new year. He says will have strong earnings growth and come with a good price tag. And food for thought, how one entrepreneur made millions from his love of flowers, fruit, and chocolate. All that and more tonight on Nightly Business Report for Friday, December 29th. Good evening, everyone, and welcome. Sue Herrera has the rest of the year off. On Wall Street, it is game, set, and match. And what a match it was. The books are closed for 2017. And for stock investors all around the globe, virtually no matter the market you were in, you made money this past year. Sometimes lots of it. Here in the U.S., the major indexes set records seemingly every week. The Dow and NASDAQ had 71 and 72 record all-time high closes, respectively. No other year comes close. The S&P 500 had 62. And those records led to numbers like these for 2017. The Dow up 25%, the NASDAQ 28%, and the S&P 500 19%. But we dug a little deeper, and we found some surprises in those numbers. Now, if you're worried these outsized results might indicate an overheated market, you're entitled to feel that way. But consider this. Going back to the Reagan administration that began in 1981, none of these gaudy percentage gains even rank in the top 5 year by year. This year's Dow comes the closest. 6th best year since 81. In fact, this wasn't even the Dow's best year this decade. 2013 was up 26.5%. And it was also, believe it or not, a calm year in the market, eerily calm. To put into perspective, 2015 and 16 combined saw the S&P 500 move 1% in either direction almost 120 times. Guess how many this year? 8. But the many happy returns weren't confined to just stocks. Oil closed above $60 a barrel for the first time in 2.5 years and rose more than 12% for the year. And the metals gold and copper also had their best years since 2010. Now, as for today, stocks kind of ran out of gas at the end. Shouldn't come as a surprise. It is, after all, the 4th straight year the averages ended the final trading day lower. The Dow dropped 118 points, finishing shy of 25,000. NASDAQ fell 46, and the S&P was off just about 14. Bob Pisani has more on the big year that was.
As traders look back on a very unusual year, the big issue is, will all the good news continue into 2018? There was a lot of it in 2017. The S&P rose 20%, its best return since 2013. The U.S. economy grew modestly, but stocks were also helped by a global economic expansion, record earnings for companies, low volatility, low interest rates, and the expectation of tax cuts that did come at the end of the year. The big winner were semiconductors. They rode the wave of buying in smartphones and smart appliances and electric vehicles, as well as home builders that rode the wave of low interest rates, limited supply, and more young people going out on their own. Commodity stocks like copper manufacturers were also strong because the global economy improved. One notable laggard was oil stocks. Even though oil moved towards $60 at the end of the year, 2-year highs, investors who were burned by the big drop in oil in 2015 and 2016, they mostly stayed away. This was also a big year for the global stock market as economies around the world improved in both developed and emerging markets. So Vietnam, India, Brazil, Hong Kong saw double-digit gains with mid-single-digit gains in much of Europe. The issue for 2018 is, will global growth continue? And what about earnings? They will get a boost next year thanks to tax cuts, but what happens after that? The final issue is inflation. It's been relatively contained because wage growth has been modest. But with the economy heating up, that may change. Now, if inflation picks up, the Federal Reserve may raise rates more aggressively, and that could stall out the rally. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Well, this past year, the NASDAQ Composite outperformed its more senior index brethren with a nearly 30% gain, topping 7,000 for the first time this year. And as Bertha Coombs tells, big-name tech led the way.
As Mark Twain put it, history doesn't repeat, but it often rhymes, and that's certainly true with the NASDAQ 100. It's the only major index up for 9 straight years since the Great Recession, making for the longest annual win streak since the big tech breakouts of the 1990s. And just as then, it's the big mega cap tech stocks that are responsible for the gains. Apple, Amazon, Microsoft, and Facebook have provided the biggest lift to the overall market and the S&P 500. And when you add in Alphabet, well, they accounted for nearly 2/3 of the NASDAQ 100's 1,500-point gain in 2017. Now, here's the rhyme part. Microsoft, which was a tech heavyweight back in the 90s, benefiting from its shift to cloud technology here over the last few years, up for 6 straight years, seeing its best annual win streak since the launch of Windows back in 1995. Consumer names were the biggest laggards of 2017. Many, like Dish, took a hit in the third quarter due to hurricanes. Now, auto parts retailer O'Reilly Automotive, which had ridden the NASDAQ rally to historic highs, down for the first time in 8 years. And Ulta Beauty, which had also seen consistently all-time highs for the last 3 years, snapping a 3-year bull run. But like a lot of retailers, both O'Reilly and Ulta pay a tax rate that is above 37%. That's what they're expecting for the fourth quarter. In 2018, under the new tax code, those retailers could see a 16-point drop in their tax rate, which could result in a big boost to earnings per share, and perhaps could get their stocks back in line with the big tech leaders. For Nightly Business Report, I'm Bertha Coombs at the NASDAQ.
Time now for our final market monitor for this week. In fact, for this year. He's got 3 domestic picks. He says we'll see a double-digit rise in earnings per share next year, thanks in part to tax reform. Last time he was on in June, he picked the S&P Small Cap 600 Index ETF, which is up 9%. iShares Core MSCI Emerging Markets ETF up 14%, and DuPont, which merged with Dow Chemical to create Dow DuPont, it is up 11%. He is Hank Smith, Chief Investment Officer and Director at Haverford Trust. Hank, welcome and Happy New Year to you. But be honest now, did you really think 2017 would be this good for equities?
Oh, I don't think anyone did, and it belied the headlines. The headlines were where all the volatility was. There was no volatility in the actual market, as you pointed out earlier. You could never have predicted a year like this, and if you did, you would have been laughed out of the room. Yeah.
Let's look at your picks for next year, and then we'll get some thoughts more broadly if we have time for next year. Let's start. A lot of them are sort of exposed to the consumer, and one is a financial. Let's begin with one of my wife's favorite companies of all because she loves home goods, TJ Maxx.
Absolutely. Best in breed management. Everyone talks about Amazon being a disruptor in the retail industry, bricks and mortar. The fact is, TJ Maxx has been a disruptor for more years than Amazon. And some of the problems at the other stores are because of TJ Maxx. Look, consumers love a bargain and they love the treasure hunt, and it doesn't matter what part of the economic cycle we're in, TJ Maxx is good for all seasons.
And many people are pointing out, as you do, that tax reform could help these retailers because they typically have high marginal tax rates. U.S. Bancorp is your financial pick. Why?
Again, best in breed management, terrific metrics, and they have 4 tailwinds going into 2018. 1, the tax reform, which will add to their earnings. 2, a pickup in GDP growth is good for them. 3, deregulation at the margin will be good for them. And finally, again, slightly higher interest rates. We're not forecasting dramatically higher interest rates, but slightly higher interest rates will be good for their net interest margins. 4 wonderful tailwinds with great management, reasonable valuation. That should be a good stock for 2018.
And your final choice, I should point out, is the parent company of CNBC, which produces Nightly Business Report. It is Comcast. Why do you like it?
Right. Well, look, all 3, TJX, U.S. Bancorp, and Comcast, have been relative laggards this year. So I'm not recommending stocks that have already had great moves. Great management. Yes, there is the issue of cable cutting, but they're getting that's been more than made up for in their internet services, where they're getting a lot of traction there. This is a giant. It's a beast. Double-digit earnings growth, reasonable valuation. It is a good entry point, in our opinion, and we think will be very good.
And one would think with the ability to expense capital equipment fully next year, that would be a beneficiary of a company like that. Hank Smith, we have to leave it there. Happy New Year. Thank you for being with us.
Happy New Year.
You bet. Well, just as peak shipping season wraps up, President Trump taking shots at the Postal Service, tweeting today, "Why is the United States Post Office, which is losing many billions of dollars a year while charging Amazon and others so little to deliver their packages, making Amazon richer and the Post Office dumber and poorer? Should be charging much more." Now, the president has never been a big fan of Amazon CEO Jeff Bezos, but does he have a point? Morgan Brennan delves into the finances of delivering packages.
The U.S. Postal Service does make money on package deliveries, but margins are razor thin compared to its most profitable business, first-class mail.
The bottom line is the post office has subsidized its parcel delivery through its first-class mail for years, for decades, really. That's why it's running at a 20 to 30% discount to the rates you're going to see via UPS or FedEx. And the beneficiary of that, of course, is Amazon or anybody else who uses them for that last mile.
The Postal Service probably should be charging more, and starting next year, rates will in fact be going up. Regulators dictate those prices, but critics argue they're still artificially low, something FedEx and UPS, for example, have voiced concern about on the Hill. For its part, Amazon relies heavily on the Postal Service for the last mile to homes. By some estimates, as many as 2/3 of its packages are sorted by the company in its own warehouses and then handed off to the quasi-governmental agency for final delivery. It makes sense, since the USPS already goes to every address. It's a less expensive option for Amazon, as well as, at times, FedEx and UPS, which also use the agency for some deliveries.
There's clearly a need for a third participant beyond FedEx and UPS, which arguably operate a duopoly. But I think what we're talking about here is getting Amazon to pay a fair rate for the service from the Postal Service, and then generally speaking, getting the volume of sales in the Postal Service to be enough for them to offset their cost.
Yet critics say those e-commerce deliveries by the USPS, which isn't funded by taxpayer money, are being subsidized by the Universal Service Obligation, which makes the USPS maintain requirements under congressional edict to ensure all users receive a certain level of service at a reasonable price. But unless Congress passes new legislation, little will likely change, especially since package delivery is how the Postal Service is reinventing itself as mail volumes plunge, and with them, profitability. For Nightly Business Report, I'm Morgan Brennan.
Up next, more confusion around that new tax code. This time, it could involve your paycheck. We'll explain. Well, as many homeowners grapple with whether to prepay their property taxes before the new tax law kicks in next week, there is also not a little bit of corporate confusion. How much to withhold from employee paychecks? Elon Mui reports.
Republicans want to say they're ringing in the new year with a new tax code.
Your tax relief is on its way.
But it will be at least a couple of weeks before you see any changes in your paycheck. Businesses are waiting on the IRS to give them some guidance on how much money they should be withholding from your wages under the new tax code. The American Payroll Association called this transition a, quote, Herculean task, and said its 17,000 employers that it represents are starting to panic. The IRS tried to calm everyone down this week, saying it does plan to provide companies some details on how much to withhold sometime in January. But the big question is whether workers will have to update their W-4s or even fill out completely new ones. The W-4 is the form that you submit to your employer listing the exemptions you plan to take. But those exemptions are all going away under the new tax code. So does that form even apply anymore? The IRS says workers don't need to make any changes right now, but it is possible that millions of employees will need to fill out new W-4s before the end of 2018. H&R Block tells us it's getting flooded with questions given the confusion over all of these changes.
This is absolutely crunch time for us. It's normally crunch time anyway, just getting ready for the filing season. And with a tax change this big, it's really adding on a whole nother level of questions, interest, curiosity. People really care about getting it right.
The danger is that workers could wind up underpaying during the year and face a huge tax bill come 2019. In the past, the IRS has waived penalties associated with underpayment to give households and businesses a little bit of breathing room during the transition. No word yet on if the IRS will do that once more. For Nightly Business Report, I'm Milan Mui in Washington.
The financial services firm Comerica is the latest company to cite the new tax reform law as a way to reward its employees. Comerica will raise its minimum wage to $15 an hour and give $1,000 bonuses to about 4,500 workers. And they won't be alone because the minimum wage is rising in several states beginning Monday. Kate Rogers tells us where.
Workers across the country will be ringing in the new year with higher pay thanks to laws or ballot initiatives. Now, these 18 states are raising their minimum wages either on December 31st or January 1st. The highest dollar amount, that'll be in Washington state at $11.50 an hour, while in Maine, workers are going to get the highest percentage increase to $10 an hour. That's according to the Employment Policies Institute. There are also 20 localities that are hiking pay. In Mountain View and Sunnyvale, California, workers are going to be paid $15 an hour. That is over a 15% increase from today's rate, while in Seattle, pay will hit $15.45 an hour for minimum wage workers. The federal minimum wage, that is still stagnant at $7.25 an hour. That hasn't moved since 2009. And with President Trump in office and Republican control of Congress, there is little chance of changing that anytime soon, which is why we're seeing more states and localities taking matters into their own hands. Currently, these 29 states and Washington, D.C., they all have wages above the federal floor. We've also seen corporate America take matters into its own hands to raise wages for workers as well. A flurry of companies at the end of this year announcing increases to their minimum wage in the wake of the tax bill, including Wells Fargo, BB&T, Comerica, and many more. Back over to you.
Kate Rogers reporting there. And Goldman Sachs expects to take a $5 billion profit hit, and that is where we begin this final market focus of the year. The bank said the new tax plan will reduce earnings by $5 billion, resulting in the company's first quarterly loss in 6 years. Now, that is expected to be a short-term, largely technical blip for the bank, however, as it is expected to largely benefit from the lower corporate tax rate over the next few years. Shares were off a fraction today at $254.76. Several private equity firms are reportedly interested in buying digital entertainment company TiVo. According to the online news site The Street, a potential deal would value TiVo at $2.5 billion. TiVo shares popped 11% to $15.60. IBM says it has reached agreement to resolve a patent lawsuit with Priceline Group that goes back to 2015. IBM sued the travel booking company, alleging that it infringed 4 key IBM patents and was unwilling to engage in meaningful discussions about it. A new agreement lets each company cross-license each other's patent portfolio. IBM shares fell a fraction to $153.42. Priceline down more than 1% at $17.37 and change. Well, the last part of this year is all about predictions for the next. And being a market prognosticator is a tough business. With more than 5 decades, though, maybe even 6 on Wall Street, the well-known trader and director of floor operations for UBS, Art Cashin, has a pretty good track record over the years. And Bob Pisani is back with a look at how some of Cashin's predictions have panned out since 2014.
It's a tough business being a market prognosticator, but Art Cashin has had a respectable track record over the years with usually more hits than misses. As we entered 2014, the 5-year-old stock market rally was continuing, but Cashin was already thinking that profit earnings and margins were starting to top out.
They have cut and diced their way down to record profit margins, followed by record profit margins, followed by record profit margins. Now, that can't continue. My 50-year history tells me that profit margins revert to the mean.
He was a little early, but the profits recession did indeed come, but not until later that year and into 2015. Going into 2015, Cashin's biggest worry was China.
The People's Bank of China is very concerned, and they are looking at doing something to stimulate, almost a way to, I don't want to use the word forced lending, but really promote lending as well as they can. And they have problems in shadow banking, and they have problems in real estate, and they'll have to work their way through that.
Right again, China was the biggest story in 2015. It rocked the investing world in the late summer with a surprised devaluation of the yuan that caused a nearly 10% drop in the S&P 500. Going into 2016, the big story was oil. Many were predicting an imminent bottom after it dropped more than 60%, but Cashin was still not convinced.
My gut tells me that it will stay low probably through the first quarter of next year, maybe a little further.
He was right. Oil continued to drop and bottomed right in the middle of the first quarter of 2016, then began a slow crawl back. But you don't hit it right all the time. At the end of last year, Cashin was concerned about the wave of populism that might sweep through Europe after Donald Trump's election.
It wouldn't take much to get the Italian government fully destabilized. We could be back to the Club Med problems with the banks. Greece is not far from returning to crisis again. So, you can say, I've seen this movie before and nobody dies, but it's a slightly different movie this time.
It didn't quite turn out that way. While populist parties did gain in European parliaments, populists were turned back in the top leadership positions throughout Europe. Still, as far as predictions go, 3 out of 4 isn't bad. For Nightly Business Report, I'm Bob Pisani.
And coming up, how an immigrant turned entrepreneur grew his small business into a $500 million international food sensation. And finally tonight, some of you may have sent an edible arrangement over the holidays as a gift, or maybe even received one. I sat down recently with the founder of the company to hear how his strong work ethic at an early age led him to create a $500 million business selling fruit, but not just any fruit.
So what you're doing is you're spinning it because you're putting a little bit of a finish on it.
Oh, look at that.
Yeah.
Entrepreneur Tariq Farid certainly has a reason to celebrate.
Cheers.
Cheers.
His company, Edible Arrangements, has mushroomed into an international sensation.
How much total revenue?
A little over 600 million.
It's a success that stems from humble beginnings. At 12 years old, Tariq and his family came to the United States from Pakistan, settling in 1981 in West Haven, Connecticut. Since money was tight, he and his siblings had to get busy fast.
My mother would sit there and, kick us out of bed every day and say, go work hard.
Tell me about your earliest days as an entrepreneur.
I had a lady living down the street from me. I would go cut her grass and help her with the lawn. And she goes, honey, if you keep working this hard, you'll be a millionaire by the time you're 35. And I like the ring of that.
Within a year, Tariq took a job with a local florist, where he learned the importance of customer service and creative design. And when an opportunity arose to buy a defunct floral shop in nearby East Haven, Connecticut, Tariq moved fast. With $6,000 borrowed from his father's boss, Tariq became the owner of Farid's Flowers.
Who gave you the lease on the shop? Who's going to sign a lease with a 17-year-old?
I don't think he knew that the 17-year-old was going to be actually running it.
But he did run it, dividing his time between the shop and school. The business grew into 3 local locations. More than a decade later, in 1999, the seed that really took root was his idea, one he'd been toying with for a couple of years: sell fruit arrangements that looked like flowers.
I used to call it a wow, that when a person receives it, when it arrives at the house, the first thing out of their mouth should be, wow. That reaction had to be there.
My favorite thing about Edible is that we're an experience company.
Somia Farid, Tariq's daughter, is the special projects manager at Edible Arrangements headquarters in Wallingford, Connecticut.
I've been in the stores ever since I was a kid. I used to hang out there after school. I started taking orders when I was 12 years old.
Still, it wasn't easy for Tariq to transition from flowers to fruit.
I would go to a supplier and say, hey, can you make me a food-safe floral container? And they'd be like, get out of here. What are you talking about? Why would we do that? We put flowers in it.
He had to create the company's entire supply chain from scratch. Everything from child-safe skewers to securing what he says is the world's freshest fruit. By 2000, the business was building real traction, and Tarek began getting requests to franchise the business.
Somebody saw the Waltham, Mass one and called from Atlanta and said, hey, I just saw this, and opened the one in Atlanta. Somebody in Atlanta called someone in New Jersey, and then somebody from New Jersey called and said, hey, I just saw this. Can I buy one for New Jersey? And next thing I know, I was in Northridge, California, opening the 8th store.
How many stores today?
1,300.
Today, Edible Arrangements is available in 9 countries. About 60% of orders come in online, but they're fulfilled by local shops. For the Farids, it's been a fruitful journey and one that continues to blossom.
There's a lot that goes into it that we have spent the last 18 years perfecting.
Tarek Farid, from immigrant to American dream, getting rich the old-fashioned way, slowly.
And man, that fruit dipped in chocolate was good. Edible arrangement fruit bouquets range in price from about $40 to upwards of $1,000 for some more extravagant custom displays. The company focusing its efforts now on expanding its product lineup to include fruit parfaits and smoothies in a push to drive brick and mortar sales. Well, that is Nightly Business Report for tonight. I'm Tyler Mathisen. On behalf of Sue Herrera, all of us at NBR, thanks for watching this year. We look forward to having you with us in 2018. Have a happy and safe New Year, everybody.